Welcome to the Salty Investors, where two blokes have a chat about markets, economies, all kinds of good stuff that you're all interested in. How are you this week, Tim?
I'm great. Yourself?
Not too bad, not too bad. Now I think you've got a bit of salt to share, as is custom. What's the salt for this week for you?
Oh, I'm mainly a bit annoyed about not getting a mortgage. Might sound a bit weird, but growing up in the 80s, hearing the horror stories, it made me just too hesitant to actually get involved. And we have terrible fixed income rates in Australia. Like we don't have Fannie and Freddie. So for non-gamblers, there's no real option. You've got to be on a variable, really. And it seems like there's an unspoken put by both sides of politics to pump up housing. Housing is seen as the savings account of most Australians, as there's no money in anyone's accounts. So it's political suicide to, go against that narrative. And I don't see that changing with high interest rates. So that's my salt for the week.
Fair enough. Yeah, and I think the problem we have, because we've got so much wealth, I'll put that in inverted commas, tied up in housing, that the amount of pain it would take to unwind that, it's not politically feasible to sustain higher interest rates. And by that I mean not even historical average interest rates. I mean just a cash rate of 3 or 4% and mortgage rates of 7%. Seems to be too much for us to bear,
Yeah. What are you salty about?
I just saw that. So that, as you know, the US is in the midst of third quarter calendar year reporting season. Netflix came out with a pretty good report. Well, that's what people thought, because they stopped their subscriber bleed. They actually added subscribers this quarter, and that market received that pretty well. But the thing I'm salty about is that Netflix has now said they're not going to give guidance on subscriber numbers, which is the very metric that they themselves pushed for years as how you sort of track their progress that's going there. So now we're not going to do that anymore. Now they're still going to give guidance on revenue growth, earnings, and they said that our top metric is to concentrate on revenue growth. Fair enough. Maybe that should have been the one to begin with, although I'd say earnings and cash flow are more important. But yeah, it's just a little bit salty. It's like, because the subscriber growth trend is not their friend anymore, they don't want to be. It's like, well, you've trained people to look at this stuff, and they'll still look at it regardless of what you say. But again, at the end of the day, I think what matters is cash flow and profits. So just a little bit. So
I looked up the price of free cash flow because I own Netflix, and I'm like, wow, it's over 100. So I'm like, it's a good quarter. It's going to be good, but wow, it's still expensive. And there's only one person that's going to be more salty than you, and that's Bill Ackman, because he sold out in the bottom here, and it's bounced back since he sold. So.
Yeah, I don't know if Bill Ackman's going through some kind of midlife crisis. Are you on Twitter at all?
No.
Now he's like, he spends his time commentating on the Ukraine-Russia war. It's like he's, I don't know, it's like he's given up on markets, and he's just now, it's geopolitics or something. I don't know. It's weird, trying to reinvent himself as a, I don't know.
Yeah, I feel for the guy. Like, just
Yeah.
Oh well,
he's one of those guys. I feel like he's too smart for his own good. Even like he's just too smart.
Did you see Einhorn's video?
No.
He used to be, the rock star back in the day, and he's just, fallen away again. So everyone just goes through these cycles,
See, something interesting. Actually, I'm going to bring them up a bit later on when we talk about copper. There's a hedge fund here in Australia called L1 Capital. They run a couple of different funds. They have like a long fund, and they have a long short fund, which is the average annual return over the last 5 years has been 17%. It's pretty good. And I heard them talking on a podcast about their shorts, and they said, "Well, we're not activists. We don't announce it, and it's not going to be, our shorts are not going to be in the paper. You're not going to read about it. We just do it sort of on the quiet. We're not trying to destroy businesses or take them down. We're just shorting things that we think are overvalued."
Mm-hmm.
And he did bring up the fact that, like, people like Einhorn in the past, the problem is they come out with these big announcements about shorting, and there are hedge funds that deliberately go in and then put a short squeeze on them, bid the stock up, in size. So, it never dawned on me until I heard that, and I thought, yeah, it is pretty dumb to go out and just announce what you're shorting, isn't it? Because it's a dangerous game, as you know. Stocks can theoretically,
and they put on
infinity.
such large positions, you can sort of see them in the books.
Yeah.
It's not like he's going to be putting like $3,000 on this short, and you won't be able to figure out when it's expiring. Like these guys, I don't know.
Yeah. So it seems that maybe Jim Chanos, who's been doing it for 35 years, right? He started Kinnikos Associates, I think, in 1985. Now he's been short. His whole business model is not. He's not like an absolute return fund. He's a hedge on long portfolios, and So that's basically the way he runs it. So you're long the market, and you put some money with him to sort of hedge out your exposure. And he's pretty cagey. He won't mention names, although he did mention that he was shorting Tesla in 2016, and he's recently said it's one of his worst shorts ever. Although it's probably working for him now, but but yeah, he doesn't give out many names. He's shorting IBM at the moment. That's one that he did put out, which is interesting.
Can that go lower? Like
he thinks
IBM can go lower.
Yeah, well, yeah. I don't know if he's still short. Maybe he's closed it out. And yeah. Oh, anyway, that's enough about shorting and salt. A few weeks back, you remember when they unexpectedly, against consensus forecast, the RBA went 25 basis points instead of 50. That started a global rally, which was snuffed out in a matter of days. And I remember you said in that time when I asked you what about it, you said they're going to look silly if they have to sort of go back on that and say raise 50 at a later date. Now, they're not doing that, but what I thought was interesting, one of the most interesting parts of this was big, long notes that if you have a look at that second sentence, it says drawing out policy adjustments would also help to keep public attention focused for a longer period on the board's resolve to return inflation to target. So I read that as we don't just want to stop and then everybody goes, all right, it's back to the casino table, right? They want people to be focused on. So to me, the takeaway from that is they're not done, and it's not going to be one more. It's not going to be, there's a meeting in November, there's a meeting in December. So I would expect 25. They just want to draw this out longer. And perhaps I think there is no meeting in January, but there'll be one in February. So that's my takeaway there. So it's not, of course, global events, if the UK melts down or whatever else happens, fine. I'm sure they can change tack. But I just thought that was an interesting take. I don't know. Am I reading too much into that? That's how I read it anyway.
Yeah, that looks pretty much on point.
Or am I read the notes because you don't have to. That's why I read the notes.
Yeah, I'm not really interested in the RBA, but yeah, I think the market will capitulate when they go, like, you can't just keep doing these 25s every month. Like, they're going to, the market will capitulate when they're going, well, you've done this 5 times already. When is this actually going to end? And from that wording, they're not going to do it. They're not going to stop until inflation gets under control. But what is that number for inflation? It's not going to be 2, surely. It's not going to be 2.
No, well, I mean, their own forecasts are that inflation through calendar year 2023 will be 4%, So they don't expect 2%, say, next year.
Okay.
So, I mean, that to me suggests again that the front running of pivots and cuts in interest rates is still too early. Still, I mean, you'd think that they'd get it by now, but it seems to be that they're still too early. And just that these things take a lot longer, like especially once you get a pickup in wages, you don't just get, I mean, that's the problem, right? That's the classic wage price spiral, that people demanding more wages because of inflation, they get their wage spiral. It can't just come down like that, really quickly. It's more difficult, takes longer. And I think they're still overestimating how quickly this will come down. I see commentary every day, though. People are saying, "Oh, this inflation is going to crash. Look out." Maybe it will. I don't know, but maybe it's been more sticky than everybody thought all along. So I'm sticking with the sticky, maybe.
Yeah, I've got a friend who asked for a 30% wage increase, and he got it. So, like, wow.
Wow. Jeez.
So, it's definitely happening. This is what happened in the 70s, and then they had to do a wage freeze, so they had to get the unions involved to do a wage freeze. So I don't know.
Is your friend got the sort of high skills that are in short demand? I mean, is he a professional person with a sort of no?
It's just
that's
parallel type industries are finding it hard to find workers, and bosses are just worried about switching people out, even though they think there's a recession coming. They want to hold on to these people because they just, we won't be able to find them if we let them go, and so they're accepting these increases. And the problem with that is then it just flows onto the customer. They're not going to
exactly. Yeah, it was exactly what we were just saying, wasn't it? Just this wage price spiral continues. Yeah, yeah. As you know, through my business, I run into a lot of small businesses, and getting apprentices is really tough at the moment. Getting them and keeping them is really tough at the moment. So, yeah, I think it's the workers have still got the upper hand at the moment for how long. And I think we're of course crush loading immigrants into the country right now. So who knows? That could reverse quicker than we think. But yeah. Well, it's good to see people getting wage. I mean, if inflation's 7 and you're getting a 30% wage rise, then good on you. You're doing well. You're crushing it.
Oh, I'm pretty sure it's backdated for a little bit, because they had no power, no power for a decade.
Yep.
Had to suck it, and then
just catching up.
Yeah. I don't. Yeah.
All right. Well, that's enough of the RBA. As you said, we don't like to talk about them too much. I just thought this is interesting. It's often said in the United States you can't have a recession without housing, capitulating, because housing's touches like 20% of the economy through construction and all the other industries that come off that. So on the left-hand side, I hope that's big enough for people to see, but it's closed sales in September. And you can see, the ones in bold, pretty nasty. Well, actually, I don't know why those ones are in bold, to be honest, because some of them, like Las Vegas, down 37%. San Diego, down 37%. But, I mean, that's some pretty nasty figures there. And you see the graph. The graph here is the unemployment rate inverted. So that's the left-hand axis against the NHAB housing index. And you see that the NHAB housing index has already rolled over. The unemployment rate, of course, hasn't. So the one thing, we talked about this last week, I think, this what are we calling it? The Great Resignation, where people sort of went away in the pandemic and didn't come back to work. And so that's the only thing that is lingering in my mind, that correlation might actually break down, and like you said, that employers who's really struggled to get workers over the last 12 to 18 months are reticent to get rid of them, because will they be able to get them back again? So maybe they'll just hold on to them longer and longer. But I think it's an interesting chart, like it says there. the housing index leads unemployment by about 10 months.
Okay.
And as we said last week, I think when we talked about job openings rather than the unemployment rate is a lagging indicator. I mean, by the time it rolls over, you're probably definitely in recession.
Yep.
But anyway, yeah, I just thought that was an interesting.
So what's that
data.
sort of saying there? Is it like what sort of unemployment rate we're looking at? Like, is that 6 or 7? It could possibly be if it keeps at this level, or
Well, right now, what are we at there?
or
So, I mean, the US is at 3.5, I think, at the moment, same as us, something like that. So,
Mm.
I mean, from that position, you'd think, like the financial crisis, we ended up just over 10 from about 4.5. And this is not the financial crisis. So, I mean, it might be more like the 90s there. See how the 90s,
Yep.
it got up, didn't quite get to 8, fairly shallow. You wouldn't think if this is just a sort of a garden variety recession, no debt implosion or anything like that. Yeah, maybe unemployment goes to 6 or 7. But
still a
yeah.
double from here, or near a double.
Yeah.
So.
Yeah. And remember this is what the Fed is looking for. Not necessarily unemployment rate, but they were targeting job openings, like we talked about last week. That's what they're targeting. So, yeah, that I think. Well, they don't want to come out and say we want to see more people unemployed, but in fact they do, don't they? Because
inflation. Yeah.
Again, the inflation is, if you've got a tight labour market, you're going to have inflation. Yeah. So that's something to watch. Housing's definitely taken a hit in the States, and we'll see if unemployment follows. Usually does. You and I don't know if we talked about copper on this podcast before, but you and I spoke about it offline. People probably know about Dr. Copper as supposed to be a harbinger of sort of economic activity and recessions, and so the copper price has fallen quite a bit.
Yep.
This comes from L1 Capital Management, and these charts are from, as you can see, I think that one's from Bloomberg, and the other one might be from Goldman Sachs. I think the one on the right hand side, which is a long-term supply gap, and so this mob is all in on the increased copper for electric cars and green energy infrastructure, batteries, etc., etc. So that light blue line on the chart on the right hand side, that's what's going to be needed. And currently, you can see where global copper production is, and there's going to be this massive gap. And so they think this is going to be a great investment the next few years, probably decade. There's a quote there from CEO of Glencore, and he stated, "Today the world consumes 30 million tons of copper per year, and by the year 2050, following this trajectory, we've got to produce 60 million tons of copper per year." So they're producing half of what they're going to need at the moment. And elsewhere in this note, they say that your average new copper mine, takes about 10 years to bring online because of all the permitting and everything. It's just a ridiculously long time. So the copper price has tanked. I mean, I looked at it last night. I think it was 3.35 down from, got close to 5 at one point, didn't it?
Yep.
$5 a pound. So it's taken a big hit. Supplies are reasonably low. So yeah, I think next week I'll bring a copper producer, an Australian one. I haven't done the numbers on it. Again, I got it from the same guys, L1 Capital. They like a company called Sandfire Resources. I don't know if you've heard of them.
Yeah.
Yep. They've just they went out and raised over $1 billion in equity, 700 million in debt to fund a new mine in Botswana, and it's pretty well. They're pretty well along the development stage. They expect to be producing copper first quarter fiscal year 24, around June next year. So it's less than a year away till they bring that on, that extra supply. And they've got a big slice of. Well, they acquired a mine in Spain last year. I think. In the latest quarter, their quarterly came out this morning, actually, and they just paid down $200 million of the debt. So if copper prices, even if they don't rebound, these guys are going to be producing a lot more copper in 12 months' time than they currently do.
Yeah.
Their share price is basically halved. I think it's down to about 360. They were up around $7 or more. I think they were over $7. They did 32 cents in earnings last year, so they're basically on a P of about 11 at the moment. Of course, the fiscal year 2023, the earnings are going to be lower, largely due to copper price changes and stuff. But if you're looking out, 2024 and beyond, and this is just preliminary. The reason I don't want to go in detail with Sandfire because I really haven't done the work. So, but maybe you have. Maybe you know more about it than I do.
Well, there's a couple of things. I'd go back and look at the 2016 bear market because you see these great big graphs from their presentations of, this is how much copper is going to be needed in the future. And you see all these inventories because everyone gets involved, and they all start up these new mines, and then more comes. It's not necessarily new mines. It's just they expand their existing mines.
Yep.
And I would look at the marginal cost of production, who's the lowest cost of production. Because let's say we don't get $5 a pound copper, can these guys still run at $2.50 a pound? Like, are they still going to be putting, EPS on you for you, or you're going to, these guys are going to, have to shut stuff down, so it's a great one because it's just so volatile. It's going to really swing hard. Like if we hit a recession here, or and you can hold on for 2 years, it's a 3 or a 4 bagger without much thinking. If you can just hold through the pain, like it's going to look the most ugliest investment you've ever made in your life. But if you've done the numbers right and you've they can survive at $2.75 is my number a pound, but $2.50 would be a little bit more margin of safety there. It's going to be a brilliant win, because no one else can handle that pain. No hedge fund or fund manager is going, I'll hold this crap for freaking 3 years, no normal fund manager can do this.
Well, that's just the thing, is like in 2019, I think copper price bottomed out close to $2. I mean, it got really low. And it's like you look at it now and you go, okay, it's come off what, a third the copper price, maybe close to it, 30% or so. And you're like, okay, it's because you're not going to pick the bottom, but how far could this go? What if the copper price gets back down below 250 and these shares just, this thing that's I know it's about 360 now. It goes to 180 or something, It's like, but like you said, if you can hold on, the story holds.
It's not like in 10 years' time we're not going to need copper. It's not like we're going to find a new element to run electricity. It's just Tesla. Hold on. Elon's found something in the back pocket here. No, but it's definitely going in that direction. So you got definitely tailwinds. So it's just can you give up the short-term pain? That's all. And I think it's a great one to do, and I think it's better than oil, because oil is like you got no understanding what the Saudis and Iran, all these African countries and the South Americans, you don't know what they're doing. They can flick a switch and become rational. You think next year, but I think it's a good one.
So did you say? Were you saying that 275 copper price is break even for Sandfire, or that's just
that's
industry in general?
That's what my number I think is inflation adjusted since the last bear market. So I'm not buying the bottom there. I'm just that's when you start looking at a tranche, because it's at 325 at the moment or something like that. It's not that
copper price. I think it was 335 this morning or something like that.
So it's got a little way to go, but yeah, everyone's bearish at the moment. So,
Hmm.
you could hit that any time and buy in a small tranche in one of these, and you're going to get the leverage instead of buying copper futures. You buy an actual company that can,
Yeah.
is a good allocator. I think Sandfire is actually one of them that's actually pretty. I don't know about
Yeah.
Glencore, like it's just too big for me.
Yeah. Well,
So
Sandfire, the thing about Sandfire and their new mine is that they're going to have a step change in production. Like this is the Botswana thing's 3.2 megaton per annum project. And, well, a megaton is a million, obviously. So 3.2 million. And there is room to expand it, they say, to about 5.2 megatons per annum. And so it's a step change in production. But are you doing it at a time when the copper price is so low that your earnings don't change? And are you able to look through that for a couple of years until you get the leverage, and it'll be off and away? I feel like maybe I've got a false confidence in the moment, because it's kind of what I did with uranium, and that's worked out well. Like I just bought the thing, halved, and now it's got tailwinds behind it. I even see Justin Trudeau in Canada today there was a tweet about him talking to someone who was trying to convince him that nuclear energy is the way to go in Canada. So yeah, I continue to like the tailwinds there, but maybe I've got some false confidence there but I feel like that these ones are, for the first time in my life, I stayed away from resource companies for most of my life, but I feel like as long as you understand, as long as you can handle the volatility, as long as you have the patience to wait for the upcycle, the upswing, you'll be okay. Yeah.
I think that's an edge that small investors that we have, like that we can, pick some of these, a little bit less known type companies, do a little bit of research, and know that you're in for a heap of pain. Like if you know that up front, no fund manager is going to go, comparing that against the index, he's going to look terrible. Like there's no way in the world that they could put that on their book.
Yeah.
Like it's just, and you got to think, okay, well, yeah, your time horizon is a little bit different. You can actually get an advantage here. So
yeah, I don't have to write a quarterly newsletter and explain why that position is down 12% for 3 quarters in a row. Yeah. Yeah. All right, so maybe I'll try and do a bit more homework on Sandfire for next week and bring that.
Nice.
So I think you've got a similar sort of chart. This I thought was interesting. This is about a week old now from Sentiment Trader, but put 3 times call volumes, and that's never happened in history before. And when it's so stacked on one side, you're thinking, geez, I got to take the other side of that. That's the only reason I put this in for, is just, Jesus Christ, if that many people lined up, and it's retail as well, so retail, so I'm just thinking, retail's probably got the wrong side of this, as they usually do. And so I think your chart is along the similar lines here, which is, you want to run through this one?
Yeah, well, it clearly shows the bears are in control here, and we should be allocating. It's under 1 here, which is a clear. If you look back all those years, 20, 18,
08.
All those times when it got under 1, you really should be putting money into the market. The only thing I'm going to say is interest rates were going in the other direction. So this time may be different, but famous last words. But it's not looking good for not allocating. And maybe
I'm surprised the 87 crash is not lower. I would have thought that being the biggest single day decline, but sorry, I interrupted you.
Well, there's a couple there. Like, you look at 08, and it's basically where we are now. Like, the whole world was imploding. Like, so.
Do you think social media has anything to do with it? Like, just the fact that so many more people are connected and reading all this stuff. I read something just this morning or yesterday about the 87 crash, how like a guy heard about it on the news, but you couldn't really, you had to wait for the Wall Street Journal to come out the next day. I mean, you couldn't, like, there weren't people talk, there was like a half-hour show on radio or something once a day, but that's about it, just that people didn't really know what was going on.
Yeah, I remember asking my dad, like, because I was in the car listening to the radio and go, oh, the whole, like, he's going, oh, yes, it's the stock market. It's always volatile. Like, and I'm like, oh, okay. But, like they were talking like it was the end of the world. Like,
yeah.
Because they remember
Well,
29,
yeah.
2020, the first, the depression, that was the fear, that sort of crash leads to, decades of nothing. So,
yeah, I remember I was in high school in 87, just started high school, and I remember it being on the news, and my parents weren't worried at all because they didn't have any stocks. They didn't care. Stock ownership by individuals in the 80s was very low, so yeah, it was just sort of a non-event. And this, but see, so we've just shown two charts that sort of say, look, you probably want to get on the opposite side of this and buy. This is Eric Balchunas, I think is the way he says his name. He wrote a book on Bogle, Jack Bogle, and how he developed. Yeah, apparently it's really good. I've heard him talk about it on a couple of podcasts. But yeah, so he looks at the ETF space pretty hard, and this is ARK flows. Yeah, they, positive one just for the last month, positive 100 million, 6 months, nearly $1 billion, year to date, 1.2 billion inflows into ARK, which sort of tells me that maybe it's not time. But then I included the quote at the bottom, which is something that Balchunas said, not on this date, but a while ago, because you can see it was when it was down 45%, it's now down 78% or something. He said that we believe it'll buck the trend of former high-flying funds. ARK benefits from unique variables, massive liquidity, its role as a complement to index funds, and Cathie Wood's social media presence. I'm not sure I buy that, because being a social media presence can change overnight. Mm-hmm. But it is interesting. I think I've said to you before, I would have thought that by now she would have gone away, basically. Like, she would be a bit of a laughing stock, but people still throwing money at her.
Money talks. It's coming from somewhere. Like, I see that more than half of the savings are gone. So maybe this is the last. We're back to 2009 levels of household savings in the US. All the stimmy checks and everything have been burnt through. So they still say there's a fair bit more dry powder there, but I don't know. Like who's putting all this money in? Like,
that's what I want to know. I want to know who is it? Is it retail? Don't know.
Yeah, it's just that's a huge amount of cash.
People still haven't given up the dream on this sort of utopian future where all these tech companies become, we're going to have 30 different Amazons, and Cathie Wood was a big enough genius to find all of them. It's still a bit delusional, I think. All right, so this is from Morningstar.
Yep.
Is that right? And they are saying that this is Morningstar's 10 most undervalued wide moat stocks as of September. That's it, September 23rd. So that's about 3 weeks ago. Yep. All right. So are you partial to any of these in particular, and why?
Well, a couple of them there are like a dog's. You think they're cyclical, like a couple of them are semis. So, you can play that world if you want, but and there's the onshoring in the US that everyone's talking about, but I just think it's way too risky. You're playing on politics there a little bit. And good luck investing in Facebook there, with the metaverse. That might not be so wise. And Comcast, who likes that? But Etsy, I've done a bit of work on there. That's quite valuable. Because
What is it for the uninitiated? What's Etsy?
basically like handmade goods that are sold. So Amazon can't compete in this. For me, it's like, oh, can Amazon beat you? Like,
Right.
is
Yeah.
Amazon going to eat your cake here? And Amazon isn't going to eat that cake because it's more homemade, specialized, custom goods that aren't
Yep.
really suitable for mass distribution.
Right.
And then you got eBay is probably the closest, but that's still not a really community-based thing. So I think Etsy will do well over time. Equifax, as you would have seen from Australia, with the Optus leak.
Yep.
I'm reading another one. There's another one. This going to keep coming, I think. And like it's an asset-light model.
It's cyclical too in terms of its with the housing, right?
Yeah. So it's got a little, and Boeing, who would go near that? Like that's been a dog. Like what's the Max airline thingy, fiasco with the engines hitting the tarmac, like they tried to re-engineer it and cut planes for. ServiceNow isn't too bad, it's just a IT type SaaS business, but it's got low return on invested capital. Polaris is really good, but it's like jet skis and snowmobiles.
Oh wow. Yeah, there must have been a lot of pull forward in that business during the pandemic, right?
Yeah, and
Jet
then
skis.
imagine what that's going to do in a recession. Like it's just going to be a dog. Like you wouldn't want to be that. And Macabre Libre, that's an Amazon for South America. So I think that would do well. It just the numbers look terrible. But if you missed out on Amazon, this is where everyone's playing at the moment. Is there. So the numbers don't look good, but hopefully Amazon gets enough cash and they just buy them out or something like that. I don't know. Jeff's a bit arrogant. He'll just rebuild everything. So yeah, I don't know. But
I assume if you live in Brazil, you've got Amazon Brazil. So what is Mercado just doing it better or what?
Well, I don't think Amazon got there. And they sort of set up in these smaller South American countries doing the same thing as Amazon. So if you get there first and you build out the infrastructure, it makes it really, Amazon's just got unlimited cash. So maybe they will parallel build with you and compete against you. But there's another company in South Korea, Coupang or something like that has done a similar thing to Amazon. It just makes it harder for Amazon to get into that area. Because the margins are going to be terrible there. But, they've just got so much reach elsewhere in the world that they can sort of handle that pain. So, yeah.
Well, see, when you say they can afford, because they've got the cash and they can afford to build it out, what do you need to build out? I mean, you're Amazon, you've got the platform. other than, put everything in Portuguese? I mean, what do you need to, what do you need to actually?
But this is why I hated Amazon. Like, I could make this another salty thing, like, because they've got to buy all the planes. They buy the planes and the warehouses. And then they started doing this stupid stuff called private labels, and then you've actually own products. And then you have to warehouse all these products and stuff. But they've started to get a bit smarter in the last few years. They started, once you've built it out, it's like a moat. And then nobody else is going to rebuild that because you just be competing directly against Amazon.
I did see an article, I can't think of it now, where they were getting rid of some of this white label stuff. Amazon. Yes. Did you see that? Yeah.
It's great because, you haven't got all that capital tied up in stock and you let other people take that risk. And then you just take a clip off, because they still get their seller fees and storing it and everything. And they can just increase that clip anytime they feel like it.
Yeah.
So that's a way smarter model. And then it doesn't, cause them to have regulatory problems as well. Because, let's say if you're selling batteries on Amazon and then Amazon starts selling batteries against you, obviously, you'd be a little bit pissed. And, I think normal people will think that's unfair competition, the shops, trying to knock you out of. And let's say if you came up with some product and then a couple of years later, Amazon go, oh, that's a great place to get into. And they've got unlimited budget to go and compete against you. Yeah. So I think it's smart for Amazon to get out of all this private label crap and just collect. I'm always looking on for return on invested capital. So, I don't care about growing revenue so much. I just want you to, every dollar you invest, to give the most
Yeah.
return. So yeah,
Yeah.
it's
Yeah.
low risk.
I was looking at Equifax.
Oh wow.
And I noticed that I mean, this thing was trading on about 46 times, and now it's down to high 20s.
Yeah.
But see, here's my problem with, and this is a sort of a broader problem with, say people like Kathy Wood who are invested in these blue sky sort of tech names, is that again, I feel like we're not taking account of the fact that there's a structural change, and that things that you thought would let me just turn that down. Sorry for the interruption. That was my accountant, by the way. I probably should take that. But that things that that we've just sort of accepted over the years, that things trade on 30 or 40 times or whatever, right? 50 times. That if you're going to have a cash risk-free rate of 4% or so, this whole section of the market has to be re-rated, and so that you see a stock like Equifax has gone from trading at 46 times to 27, and okay, some of that's real estate related. There was a boom in 21, fair enough, people got ahead of themselves, but 27 times for a company whose earnings are going to be, from what I saw, if you just take the estimates, are going to be flat this year, flat earnings, and of course it's expected to pick up the year later. 27 times return on, I mean, their return on invested capital is not that great. It's only sort of low teens or something. Yep. Return on equities in the teens. I mean, is it a 27 times business, or is it a 17 times business, or is it a 14 times business? I don't know. That's why that we talked about the sort of ARK inflows. People still think we're going to go back to that world sort of pretty quickly, and I just don't know, but maybe people haven't got their head around that. Value investing's back, and stocks with low PEs and wide moats, and with even just slightly above average rates of growth might be the way to go. People are still looking at these tech names and 30, 40 times. I'm going to pay 35 times for something that was, well, it was 70 times earlier in the year, or 80 times. Yeah, but 35 times is not cheap if you don't have, if you're only growing at GDP. I mean, I don't know. Yeah.
But where are people going to invest? This is the thing. If they've still got capital to burn, they're going to go into bonds, or like.
Well, there probably will be at some point, interest rates will stop going up. Central banks will stop hiking, and I guess there will be a pile into bonds at that point, right? Because people will think that that's the pivot. But even I saw recently, someone was commenting on the fact that, let's say, consumer staples, so Australia, Woolies or whatever, or in the United States, say it's Procter and Gamble or something like that. You have a look at those charts. That's where people have been hiding out. So when the turn comes, and when interest rates start getting cut or whatever, there's no real upside there, because consumer staples are already fully valued. So you don't want to be in those. I mean, if you're hiding out there now, well done, because your losses are much less. But you don't want to be caught in those when the upturn comes. So it's hard, isn't it? It's hard. That's why I know if you can, as I said, if you can wait it out in these sort of selected commodity areas, maybe that's a better way to play it, because it's not a crowded trade, because people are enamored with things like ESG and new energy, and people are generally turned off the volatility in commodities and the associated stocks. Maybe. Yeah.
Yes.
Right. Anything else to say on these?
No. I was the only ones.
Do you know how they decided the criteria of undervalued for these?
Oh, I don't know. It's just,
no.
I think they look at price to free cash flow. You look at Meta, for example, there, it just looks like a bargain, but then,
right.
And if you look at what they're burning their money into, this is why it upsets me. It's like, oh yeah, I think Meta should have gone and done a Twitter clone, TikTok clone, you
Right.
know. But
Yeah.
now they've gone, oh, we'll look, 50 years into the future or 100 years into the future and create the
Yeah.
metaverse. Like, just
Yeah.
insane,
Yeah.
So you can't say that, for me, looking, oh, is that capital deployed going to be invested wisely and going to get a return? I'm like, oh, it's
Yeah.
still
Well, these
producing.
guys, yeah.
You're
Yeah,
saying?
I think they could be the first one through the fence and they get shot.
Yeah.
They spend all this money on the metaverse, but they're not around to capitalize on it.
Yeah, I've heard you heard
Yeah,
the mousetrap one where, the first mouse gets hit by the mousetrap and mousetrap goes
the other
off,
one
and
gets
then
the cheese.
the second one gets the cheese. It feels a little bit like that to me. It just feels
Yeah,
way too early, especially after COVID, where everyone wanted to get outside and whatever, and you're going to go, oh, what we're going to do is put you all inside a computer. It's just,
yeah,
I don't know.
yeah,
I think he's lost it a little bit there. So, um, yeah, but the other ones that we talked about, like Microsoft and Google, they're all
mm,
a little bit more stable, I think, and I think they're probably somewhere I'll be looking a little bit closer
yeah.
to allocate. But I'm liking some of these medical companies. I'm trying to learn about medical science currently.
All right.
Yeah, sort of the testing, because I think as we're going forward, things like food quality and things like that will become more prized, and governments will regulate to make sure that as more scandals happen, that people are testing and things like that. So I think they've got a bit of a runway to get, for the future, I think, but
Yeah,
still a gamble. But I'm keen on the commodity one as well. So it's just,
yeah,
how low
yeah.
can you go? It's just, I just, yeah, not sure yet. That's all.
Yeah. All right. Maybe we'll call it a day then. Hey,
Yep.
for this week. Thanks everybody for listening. We have been the Salty Investors, and we'll catch you next time.
Yes.